Let's talk about venture capital. I'm currently a venture capitalist, and I think it makes sense to do venture capital later in your career. And the reason is because you want to have enough business experience so that you can sit on boards of companies and give them proper advice. So we say goodbye for now to Sally, the sell-side analyst. We'll see her again very soon. And we say hello again to Victor, the venture capital analyst. Okay, so let's talk about the venture capital sector. What we'll do is we'll kick it off with the what. Venture capital firms invest in early stage companies. You get a board seat if you lead an investment round. And when you get your first board seat, I remember when I got my first board seat, I was a little bit worried. I didn't know what to do. Just sit down and observe how the board meeting works at first. Don't say much in the first meeting or so. Just observe. Don't feel like you have to speak as well. Less is more. If you have something important to say, then say it. And actually, don't think you have to learn the ropes too of how boards work, because a lot of times you can just use common sense. But every board has a different corporate culture, so just kind of observe at first. Okay. So you basically, when you're on the board, you're helping startups grow. You're helping them with customer introductions and that sort of thing. And when I'm on boards, I always think of myself as kind of a prosthetic extension of the management team. I'm there to support them. I'm there to work for them, but also I'm there to represent my investors. So I have a fiduciary duty to them to make sure that the company is being run correctly. Okay, so venture capital starts usually in the early stages with a seed investment. You have an idea, you don't have a product, you get a little bit of money from friends and family and angel investors. Okay, and then a year or two later, your product works. You're starting to generate a little bit of revenue, and so a big venture capital firm will lead the Series A, the first round. Then a year or two later, another firm will lead the Series B, another firm the Series C, D, and then eventually, when revenue growth is positive but slowing, maybe in year 7 or 8, then you go public. So the VC analysts are always there until the IPO, but then when the company goes public, they don't sell the shares right away. They're not allowed to by law. They're locked up. They can sell 6 months after IPO. And that's why a lot of the time you'll see, no matter how good a company is, you'll see the stock go down 6 months after IPO, because that's when the insiders can sell. And in venture capital, you don't get liquidity that often, right? Maybe every 3, 5, 7 years, whatever it is. So you're kind of desperate to take profits if you haven't had a liquidity event, that is. And if you love the company, you hold on to it forever. Like, there's a great venture capital firm called Sutter Hill, and they led an investment round on a semiconductor company called NVIDIA, which makes graphics chips. And they still hold those shares. And even John Doerr, who is the top partner at Kleiner Perkins, he was one of the first investors in Amazon, and he still owns those shares. And he's up literally over 50,000% on those shares. He hasn't sold a single share yet. Okay, so it's a highly competitive and cyclical business as well. The best firms get the best deals, and most other firms don't get anything remotely as cool as the top firms like Sequoia or Kleiner Perkins or Andreessen Horowitz. And it's a very cyclical business. In a bull market, it's usually capital chasing entrepreneurs, and then in a bear or negative market, it's entrepreneurs chasing capital. So it changes quite quickly. And the most successful deals tend to be, for now, in tech and biotech. And historically, that's the case. Kleiner Perkins, their first big deal was in Genentech, which is a biotech company. Many years ago, they did extraordinarily well in that area. And of course, you know of all the big, incredible tech deals like Instagram, Facebook, etc. Okay, who? Experienced executives, usually with startup experience, get jobs as venture capitalists. That's not always the case. Sometimes they come from Wall Street, but more often than not, it's people that have worked in an industry and they thoroughly understand an industry. A lot of them have MBAs, but not all of them. And investors are usually very high net worth investors or institutions, and they have to be accredited investors. And we cover this in the hedge fund portion of this course as well. You have to have a certain net worth before you're allowed to invest. And the reason is because the government wants to protect you, the investor, because these are very illiquid investments. You become a stockholder, so to speak. You own them for many, many years, and you can't sell, unlike with the stock market. So venture capital firms primarily focus on the best team, the best CEO, the best athlete. Ideas are commodities, but execution is not. Also, they focus on huge markets that are ripe for disruption. A lot of the time, venture capital firms won't invest in a company unless the size of the market that they're operating in is in the multi-billions of dollars. And the top 10 firms get most of the great deals. Okay, so who are the top venture capitalists? Okay, the source here is Forbes. Every year has this awesome list of the top 100 venture capitalists in the world, and it's called the Midas list because whatever they touch turns to gold. And so the most recent one was released, and of course we have somebody from Sequoia at the top. That's the best venture capital firm. Actually, we have a couple people from Sequoia. We also have Doug Leone there as well, and he's absolutely brilliant. And then we have Mary Meeker there in the middle, and she used to be an investment banker. So she worked on the finance side at Morgan Stanley, and they called her the queen of the internet. She was an incredible sell-side analyst, and then she was an incredible investment banker. Now she's she's an incredible venture capital partner. And again, go to slideshare.net to see some of Mary Meeker's presentations, which are great. And then at the bottom there, we've got Peter Thiel. Peter was actually the first employee or one of the founders of PayPal. And then he was the very first investor in Facebook. And you can watch that movie, The Social Network, and kind of get an idea of how he interacted with the management of Facebook and how he added value. And he's a brilliant man because he believes that you have to invest in founders and back them forever. And that's why the name of his fund is Founders Fund. And I personally hate investments when all of the founders leave. Okay, when was venture capital created? Well, in the late 1950s, there was an event called Sputnik, which we all know is a satellite that Russia sent up in space. And America was brokenhearted because Russia beat the Americans to space. Okay, and so what happened was the president at the time, which was John F. Kennedy, he basically created NASA, and the sole goal of NASA was to beat Russia to the moon. Okay, we want to put the first person on the moon. But in order to do that, they had to actually create the first venture capital investment that mattered ever, which was in a company called Fairchild Semiconductor. And they call these people the traitorous eight, and they're rock stars to me. And they were here in the San Francisco Valley, and they started a company called Fairchild, and they were able to create 100,000 little processors that fit into the fuselage or top part of the rocket, which is the reason that NASA was able to send the first person to the moon. And then Fairchild got too big and too bureaucratic, and then Fairchildren came out of it, including companies like Intel, AMD, NVIDIA, and the rest is history. Okay, so why does venture capital exist? Well, banks aren't willing to take the same risks as equity or venture capital investors, right? And so these early stage investments are very risky. Many of them can go belly up. If a venture capital firm gets one or two incredible companies, 5, 10, 20 baggers in one fund, then that one company pays for the entire fund, sometimes multiple times over. You only have to be right one time in business. You never want to deal with the bank early on anyway, because if you miss one payment, the banks are ruthless and they'll take your business away. And if you don't have the right legal structure, they'll take away your house as well. Okay, and so venture capital exists because it's a very easy way for early stage companies to get money, okay? Especially if you have a great management team. If you don't have a great management team or you're a first-time founder, don't worry. Just get a board of advisors. Leverage LinkedIn like I've talked about before. Find people with similar backgrounds to you that work at cool companies like Google or Facebook if you're starting a tech company, and ask them to be on your board, okay? It works out well. Okay, so venture capital firms get what are called preferred shares, not all the time. Sometimes they get common, and preferred shares have a liquidation preference. And the returns can be off the charts high. And that's why a lot of venture capital firms look for what's called a 5x5, which is a 500% return within 5 years. Why? Because a lot of their investments won't work out. Okay, and venture capital firms are very helpful in getting startups to succeed. And so I love to introduce a lot of the companies I'm on the boards of to customers. And that's the best way that I think you can add value. Okay, how? How are VC firms structured? Well, a venture capital firm is usually a limited liability corporation. It's set up that way so that the general partners that work at the VC firm are protected if they get sued. And so the general partners own part of the venture capital firm, and there's usually 3 to 5 to 10. These firms are usually quite small, which is why politics aren't that egregious here. And then these general partners own parts of funds. They usually call them Fund 1 or Fund 2 or Fund 3, and they launch them every couple of years. And in each fund, there are usually 10 or more investments. And venture capital firms usually have a risk management metric where each position is well under 10% of capital. And so you can see in this hypothetical example, in Fund 2 of this hypothetical venture capital firm, the positions include Uber, Pinterest, and Airbnb. So the fees, just like in the hedge fund industry, are 2 and 20%, which means an annual 2% fee, which just pays for the lights and the office space and travel, etc., and salaries. And then there's something called a 20% incentive fee, which basically means the venture capitalists get paid 20% of every dollar you invest. But if you invest $100 and it's a 10-bagger, and your $100 is worth $1,000, you give up $200 to the venture capital firm. So you take $800 yourself. So you're happy, the venture capital firm is happy, and your interests are completely aligned. And it usually takes at least 5 years for a venture capital firm to harvest an investment, meaning to make money from it and return it to you, the investor. And they make money from it in a couple of ways. Number one, if the company gets acquired, then they return cash to you. And number two, if the company goes public 6 months after the IPO, you get shares, and then you decide, you the investor, what to do with those shares. You can sell them or keep them. Okay, and where are the venture capital firms located? Actually, about 50% of all VC firms are in the San Francisco Bay Area. People like to take a lot of risks here in the Bay Area for many different reasons. Part of it is given the fact that you had the hippie peace movement at Berkeley back in the 60s. And what happened was an open type culture developed here where people love to share ideas and not hoard information. And there's kind of a fertile Tigris and Euphrates type environment in the San Francisco Bay Area, whereby it's easy to get capital, it's easy to get great employees, and it took about 50 years for Silicon Valley to develop. And other regions of the world have tried to copy it. It's tough. They will be successful. It just takes time because, again, with Silicon Valley, from the 60s until today, it's about 50 years worth of development. And I put down there at the bottom a little note. I'm asking you all, please, if you're from overseas and you have a map of the world with venture capital firms, please send it to me as well. And I'll include it in this portion of the lecture as well. Thanks.